AI-driven earnings optimism is running head-on into a tougher central bank regime and fragile geopolitics, and equity markets are being forced to decide which story dominates. Welcome to vTalkInsight, Equity Pulse Daily for June 22nd, 2026. Today we will connect the shift to higher real yields, the trillion-dollar artificial intelligence build-out, and the latest Middle East and UK political developments into one equity market narrative. The starting point for this equity backdrop is a Federal Reserve that has turned more hawkish under Kevin Warsh, restoring some policy credibility, but locking in a regime of higher real yields. Commentary points to tighter global financial conditions and a stronger U.S. dollar as the direct result, which tends to pressure more speculative assets and has already weighed on areas like gold and silver. At the same time, expectations are coalescing around the Fed staying on hold for the rest of the year, rather than restarting an aggressive hiking cycle. That pause at restrictive levels is seen as broadly supportive for equities because it reduces near-term policy surprise risk, even though the cost of capital remains meaningfully higher than in the last cycle. Markets have been stress-testing this new regime for several days now. U.S. equities sold off around the Fed communication but recovered quickly, and the volatility index has drifted back toward the mid-teens, signaling that higher yields are still being read more as a growth signal than a stagflation alarm. Under the surface, enthusiasm for artificial intelligence continues to do a lot of the heavy lifting for risk assets. Global equities have shown resilience this week despite geopolitical noise, and forecasts now see AI-driven capital expenditure approaching $1 trillion by 2028, with persistent component shortages and strong demand supporting earnings in the AI ecosystem. That AI boom is feeding back into the macro loop through valuations and wealth effects. Elevated U.S. stock prices, particularly in AI leaders, are viewed as contributing to inflation by supporting demand, which in turn makes it harder for the Fed to cool the economy with traditional rate hikes alone and raises the possibility of unconventional tools such as changes in reserve requirements. The balance of risks for equities therefore hinges on two questions. Can inflation be contained while AI earnings stay strong enough to justify current multiples? And does the Fed feel compelled to lean harder against the wealth effect? Watch real yield moves, the dollar, and any shift in Fed rhetoric on non-traditional tools as early signals for whether this constructive yet fragile equilibrium can hold. The second major axis for equities remains energy and geopolitics, with the Strait of Hormuz at the center. An interim understanding between the U.S. and Iran has allowed a partial reopening and pushed oil back toward the low 80s, and prices are down roughly 9% this week, but traders still expect a lasting risk premium on barrels moving through the region. Despite the memorandum, shipping behavior shows how fragile confidence is. Tanker flows have improved only gradually, new cargo bookings are scarce, and the toll-free arrangement for commercial traffic has a 60-day expiry, all against a backdrop of delayed nuclear talks and ongoing clashes between Israel and Lebanon. These frictions spill into broader inflation through both energy and food. Disruptions in the Strait have raised freight and input costs across the global food supply chain, while UK food prices, still about 40% above 2019 levels, illustrate how those shocks can become sticky, and Morocco's fertilizer exports are being hit by sulfur supply issues. Europe and the UK are especially exposed as large energy importers. European bond yields have firmed when oil trades above $80, while in the UK falling energy prices and a recent Middle East peace deal briefly eased pressure on the Bank of England before renewed tensions reintroduce tail risk. For equities, that means ongoing volatility in energy producers, transport, consumer staples, and parts of agriculture, even if the headline oil price has retreated. Regionally, the United States still looks like the relative winner in this setup. Expected U.S. earnings growth around 20% this year, combined with energy export capacity and leadership in the AI boom, reinforces the perception of superior growth, and recent analysis now anticipates a broadly firmer U.S. dollar driven by this AI exceptionalism and resilience to global shocks. Europe, by contrast, faces softer growth even as some of the worst energy tail risks have eased. European leaders expect fewer additional rate hikes from a European central bank as oil stabilizes in the mid-70s to 80s, and major banks like Goldman Sachs and Barclays are upgrading European equity prospects conditional on Middle East tensions continuing to cool, with energy stocks already outperforming on modest oil gains. The UK stands out as a more complex risk case. Political instability, including speculation about a leadership challenge to Prime Minister Starmer and the prospect of yet another change of government, is colliding with the highest borrowing costs in the G7, limited fiscal headroom, sticky food inflation, and renewed questions over Scotland's status and potential bond issuance, all of which keep gilt markets and the pound highly sensitive to policy missteps. Japan adds another layer of divergence. Even after a recent rate hike, the Bank of Japan remains behind the curve with deeply negative real rates and very easy financial conditions, which continues to pressure the yen and attract momentum traders into currency moves, raising questions about how long this divergence with a hawkish Fed and less aggressive ECB can persist without causing more pronounced shifts in regional equity flows. The structural story running through all of this is the AI build-out and its spillovers. Capital expenditure linked to AI is projected to approach $1 trillion by 2028, with ongoing shortages in compute and memory supporting robust earnings expectations for the broader AI supply chain and underpinning forecasts that put the S&P 500 above 8,000 next year, as long as Fed tightening does not re-accelerate. That investment wave is colliding with an already fragmented energy system and surging power needs. Rising AI-related electricity demand is creating clear tailwinds for renewables and grid infrastructure, and in Europe the AI theme increasingly includes industrials, data center operators, and sustainable power providers as potential beneficiaries of long-duration capital. Regulation and sovereignty are also starting to matter more for equity leadership. From August, the European Union will enforce new rules on highly capable AI models, while policymakers push for European-controlled technology in critical sectors and reduce reliance on non-EU providers such as Palantir, which could shift where value accrues along the software and infrastructure stack. One consequence is growing concentration and valuation tension. Many portfolios remain heavily skewed, with around 40% of clients reportedly exposed to fewer than 10 stocks, and there is a view that heavy capital flows into disruptive AI names may, over time, compress valuations in more traditional segments as uncertainty around long-term business models rises. Recent single stock moves help translate these macro themes into micro signals. Accenture's shares dropped about 20% in their worst one-day move on record after a revenue disappointment, with commentary pointing to investor concern that AI technologies could disrupt parts of the consulting model and shift corporate spending priorities toward infrastructure and automation rather than traditional services. ASML has come under pressure as well, falling after reports that U.S. officials questioned whether advanced chip-making tools had reached China despite export controls, even as the company insists no extreme ultraviolet machines were shipped. The episode underlines ASML's unique monopoly over EUV technology, the bottleneck it represents for Chinese chipmakers, and the broader risk that tighter export rules and trade actions, including a new U.S. Section 301 probe into German pharmaceuticals, could weigh on European technology and healthcare stocks. Elsewhere, Vestas has rallied on an upgrade from J.P. Morgan, citing strong momentum and scope for higher guidance, aligning with the theme of renewables benefiting from AI-driven power demand, while Novo Nordisk gained on plans to expand obesity drug incubators across Europe, reinforcing confidence in its growth pipeline. In contrast, Unite Group sold off after a large shareholder placed stock, a reminder that technical supply and ownership structure can move prices sharply even when management is focused on improving asset quality. Stepping back, the equity picture is defined by tension between three forces: a more hawkish but currently paused Fed and higher real yields, a powerful AI-driven earnings and capex cycle, and a web of geopolitical and political risks stretching from the Strait of Hormuz to Westminster. So far, strong AI earnings and U.S. exceptionalism are offsetting tighter policy and energy uncertainty, keeping volatility contained and supporting a constructive, if narrow, risk tone. But persistent food and energy inflation, UK fiscal and constitutional stress, and growing regulatory pressure around AI and trade suggest that dispersion, not a simple index trend, is likely to remain the core market feature. Watch real yields and the dollar, oil flows through Hormuz, UK political headlines, and the next set of AI capex and regulation updates for clues on whether this balance tilts toward a broader equity advance or a valuation reset. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.